These are my top 5 dividend stocks to buy right now. They're not the companies with highest dividend yields. However, they're profitable, established, safe businesses that continue growing their dividend every year. Some of those companies have outperformed S&P 500 by a wide margin over the last 10 years, and I believe they will continue outperforming in the future. Stock number 1 is Automatic Data Processing, ticker symbol ADP. ADP might not be a household name, but it should be for dividend growth investors. The company has raised its dividend for the past 49 years, making them a dividend aristocrat. ADP is the largest payroll provider in the world with over 1 million clients across 140 countries. About 15% of the US market is covered by automatic data processing. They also offer HR and human capital management software. If you worked a W-2 job in the US, you likely come across some of their services, whether it was related to your paychecks or your onboarding documentation. Many businesses prefer outsourcing these services as they require a lot of legal expertise. They require an established infrastructure, and it allows ADP customers to focus on their core business activities instead of dealing with these complicated areas of running a company. Personally, I really like ADP, as ADP enjoys a wide economic moat because of its high switching costs and its enormous scale. The company is consistently ranked among the best of vendors in its key product offerings by industry analysts, and its sheer scale also creates efficiencies that allow it to charge really competitive rates that smaller vendors simply can't match. Plus, it is expensive for businesses to switch to a new payroll provider. So, once ADP locks in a new business as a client, it is unlikely that this business will ever leave ADP. That is why ADP enjoys an impressive 95% retention rate. In terms of its financials, the company has been consistently growing its revenue and its net profit. They've also significantly improved their net profit margin, and ADP does stock buybacks as well. To be fair, the company has taken on a lot of new debt recently, but the management used this money to improve the company, as you can see from return on asset and return on invested capital. This means that not only the company is making more money, they're also becoming more effective at making money. While the current dividend yield isn't that impressive at just 2.2% as of recording of this video, the dividend growth rate has averaged 11% throughout the last decade. This consistent growth, coupled with a healthy payout ratio and strong financials, positions ADP as a reliable income generator for investors. I believe that the company will continue growing pretty much as long as the US job market continues to grow. Plus, a lot of growth can be potentially driven by different innovations and improvements to their existing platforms, as well as launching new products. Of course, ADP is not without risks. ADP is a company that is uniquely vulnerable to economic downturns. As businesses may start laying people off or slowing down their hiring, less capital will be allocated to HR and payroll services. Companies like Paychecks or Workday offer a similar portfolio of products and could potentially poach ADP clients if they offered services at a cheaper rate. I own ADP shares and I plan to buy more on dips as I have very high conviction in this company. Stock number 2 is S&P Global, ticker symbol SPGI. S&P Global is known as the world's largest credit rating agency, but over the last years, the company has evolved and expanded into market data, analytics, benchmarks, and related software. As a result, SPGI shares have returned 510% over the past 10 years, beating the S&P's return of just about 180%. I really like S&P Global, and I own their stock as well, because I believe it gives you exposure to the financial sector without having to invest into banks or fintech companies. In general, I am not a fan of the finance and lending sector because I believe that traditional banks operate without any real economic moat, as the banking sector is extremely competitive. And many fintech companies have really shaky business models and basically require low interest rates to grow. S&P Global, on the other hand, offers you exposure to the financial sector as it essentially sells data, research, and software to serve the financial sector, but SPGI themselves don't incur all those negatives and risks associated with banking and lending businesses. The company also generates most of its revenue from recurring sources, which makes their revenue not only stable, but also predictable. SPGI has also been growing its revenue, gross and net profit, and I believe there is a lot more room for the company to continue growing. During its last earnings call, the company also highlighted its developments in AI-fueled services. While the current dividend yield is quite small, at just 0.83%, SPGI has also been consistently growing its dividend. The only reason why the yield is so low is because of its amazing appreciation in price. Plus, the company has a healthy payout ratio as well. And I believe there is a lot more room for the company to continue growing as it launches new products and grows its market share. As you might have expected, the company's shares are in no way undervalued. Many people would probably say that SPGI is expensive. SPGI is trading at a PA ratio of 49, which is higher than what it used to trade in the last 10 years. With all this in mind, I would not make the case that investors should initiate a full position at these prices. Given the market's recent rally, I believe SPGI stock could potentially see correction in the coming months. So, if you're interested in dollar cost averaging into this name, consider adding just a little bit right now and wait for potentially better prices in the future. Stock number 3 is Caterpillar, ticker symbol CAT. Caterpillar is a big player in farm and construction machinery and is a proud member of Dividend Aristocrats Club with 30 consecutive years of dividend increases. Over the past decade, Caterpillar has also outperformed S&P 500, delivering a total return of 340%, beating S&P 500 by more than 100 points. Caterpillar has also outshined the ISM Manufacturing Index, showcasing the company's amazing management. They're not just riding the wave of economic growth, they're finding new opportunities, they're optimizing their current operations, and they're effectively hedging their bets. Right now, Caterpillar has some challenges, but also big opportunities. Recent revenue growth in Q1 2024 actually slowed with a modest 0.4% year-over-year decline, but I am confident that Caterpillar can bounce back and continue growing. Even though the revenue growth has slowed, gross and net profit actually improved significantly because of improved profit margins. CAT also does share buybacks and has a relatively low and healthy payout ratio. A key driver for Caterpillar's future growth is the rising demand in its engines, especially for data centers. Recognizing this opportunity, Caterpillar is investing heavily to boost its capacity. From a valuation perspective, Caterpillar is really attractive right now. The stock is trading at a PE ratio of 15.77, actually below what it has been trading at recently. Concerns about dealer inventory levels have weighed on investor sentiment, but it's important to note that a significant portion of this inventory is related to projects with firm customer orders, indicating that the situation with dealer inventory isn't actually as bad as some analysts make it sound. I believe that Caterpillar is poised for fundamental recovery, and those who invest now could be well rewarded in years to come. And if you're like me and your portfolio is heavily concentrated in technology stocks, companies like Caterpillar offer you diversification and exposure to a different sector of the economy. But again, don't invest all your budget at once. Take your time, build your position gradually through dollar cost averaging. This approach will keep you sleeping well at night and give you the best risk-reward over the long term. Stock number 4 is Johnson & Johnson, ticker symbol J&J. J&J is a global healthcare company serving 350 million patients each year. Its activities are concentrated in 2 primary segments, pharmaceuticals and medtech. Not only is Johnson & Johnson a dividend aristocrat, but it is also a dividend king. I actually worked at J&J for a couple of years, And I vividly remember being blown away when I saw full J&J product catalog. When you buy J&J stock, you buy one of the most diversified product portfolios in the world, and its core products grow in sales each year. J&J right now has an attractive yield, which is above what it was recently trading at, with a very healthy payout ratio of just 33%. Looking at the company's PE ratio, price to sales ratio, J&J is actually underpriced relative to the multiples it was trading at historically. So if you're a dividend investor, J&J, in my opinion, is a great choice at this price. If you want exposure to the healthcare sector, I believe J&J is your safest bet simply because of how diversified they are. Plus, one of J&J's key strengths is its innovative pharmaceuticals pipeline. The company invests heavily in research and development, spending over $14 billion annually in order to advance its portfolio. J&J has a really promising oncology pipeline with multiple products in various stages of clinical trials that can hopefully satisfy significant unmet medical needs. Finally, stock number 5 is Visa, ticker symbol V. Even though Visa's dividend yield is modest, it remains my all-time favorite dividend stock. I own Visa's stock, and I believe it's an incredible buy and hold investment at its current price for several reasons. Reason number 1, Visa's business model is simple, yet it is supported by a substantial economic moat. Alongside MasterCard and American Express, Visa essentially operates within a legal oligopoly, and Visa is the largest of the three. When looking for investment opportunities, I always search for companies that are able to operate as a legal monopolies or that have at least some sort of strong competitive advantage, as this makes their business more secure and less susceptible to disruption from new competitors entering the space. With over 4.5 billion cards in circulation, Visa's momentum shows no signs of stopping. The scale of its network and its infrastructure is something that no one can easily replicate. This is an extremely powerful position to be in for a company. Reason number 2 is its consistent dividend growth. Visa has increased its dividend for 16 consecutive years ever since its IPO in 2008. With a payout ratio of only 23%, the dividend is well covered by a company's profits. Plus, there will be still a lot of money left over to spend on research and development and on acquisitions. Reason number 3 is Visa's near infinite scalability at a fixed cost. Since 2019, Visa's network costs have risen by just 2%, meaning that the company incurs minimal additional costs for processing more transactions. Inflation is a good example of how this works for Visa. For example, if an item used to cost $20 and now let's say it costs $30 due to inflation, Visa collects a fee on the higher transaction amount, increasing its revenue without any extra effort. The scalability is truly incredible, and the business model is about as good as it gets when it comes to hedging inflation. Visa also has almost no net debt, with cash offsetting nearly all long-term debt. Its profitability is outstanding, with a return on equity averaging 40.6% over the past 5 years, and a net margin averaging 51%. Plus, the company is successfully growing its revenue and its profit. Of course, like with any company, there are risks. Regulatory scrutiny is a significant concern, especially given the monopolistic nature of the industry. Visa is also vulnerable to broader economic trends, as its revenue is essentially tied to global spending. A major recession could impact Visa's earnings, and as a global payment processor, Visa is also exposed to geopolitical risks and currency fluctuations. However, still, fundamentally, Visa is one of the strongest businesses in the world. It benefits from durable competitive advantages, including its brand power, an extensive network effect, a built-out global digital infrastructure, and near infinite scalability. Despite the stock's seemingly high valuation, its price-to-earnings and price-to-sales ratios are around historical levels, possibly even a bit lower. Visa is a company that you can hold for the rest of your life. So take your time and build your stake thoughtfully and gradually. This approach, I believe, works best over the long term. So those were my top 5 dividend stocks to buy right now. If you enjoyed the video, please give it a like and subscribe to the channel for more videos like this. Thanks for watching. Bye.